Okay, welcome everybody to our 180 Markets Zoom. Investors, I'd say that Sean and I get the question no less than every 3 or 4 days. Crypto, what do we do? What are our thoughts? What should we do? And so forth and so on. Well, finally, we have answers for you. And maybe I'll turn it over to Sean now for a couple minutes to explain, and then we'll introduce our star guest fund manager, Tim Johnson.
Thanks, Greg. We don't definitely have answers. We've got a possible solution. Yeah, so as Greg said, we're often asked, do we invest, do we trade in cryptos? And up to about 6 to 9 months ago, my answer would always be, unfortunately, no. We've missed out on the big run up, and unfortunately, we didn't touch it. Obviously, it's turned a bit, and it's not as exciting and bullish as it once was. But for me, as an investor in on the ASX, it was one area that I definitely missed out on. And I guess I was always a bit too scared or uncertain to try. Like, I didn't really understand what a wallet was, why you needed a wallet, how to buy one, and how safe your investment is. So about 3 months ago, someone said to me, why don't you just invest in the fund? And for me, that's what I'm going to be doing. Whether it's the fund we're presenting tonight, I'm not sure. Tim, we'll see how good of a salesperson you are. Yeah, but personally, myself and Greg are going to be investing in the fund. And yeah, it's for us, I think it's the only way going forward. It's too hard to just go into something blindly, and there are a lot of dangers in the area. I still don't understand why you need a wallet and why you can't just have a ComSec account. And yeah, I want to understand a bit more, especially about NFTs and Ethereum and Dotcoin and small coin and Cumcoin and whatever other coins there are. So
and
yeah,
Tim,
Tim will let you explain to all of us the difference in all the different coins, and you as a manager, why we should trust you with our money.
Right.
Excellent. Thank you, guys. Thank you, Sean. Thank you, Greg. Appreciate the introduction. I'm feeling the pressure. There's a bit of pressure there to convince you. No, but we like to play a role in the space of just providing hopefully nice balanced information about what to consider when investing in crypto. So yeah, as the guy said, my name's Tim Johnston. I'm managing director of Apollo Capital. They're on the shirt, and we've been running crypto funds now for about 4 years. We launched the Apollo Capital Fund on the 1st of February 2018, which was the start of a pretty severe bear market. For the first couple of years, no one really wanted to talk to us. And then obviously in the last couple of years, markets have performed very well, and now our returns are quite strong. But coming back, like, why did we launch a crypto fund? And I think you guys sort of touched on it, but I think in crypto, I think it makes a lot of sense for a fund structure. It can be the Wild West out there. There's I think last I checked, there was like 17,000 different crypto assets. So most of them are probably worthless. Some of them are fraudsters. Some of them are scams. But there's some really good value there. Some really good things out there. And so we think a fund where it puts together a professionally managed, actively managed portfolio of crypto assets, which may go up in value. Hopefully they will. They obviously don't all go up. We think that makes a lot of sense. And the other reason a fund I think makes sense is we take this for granted for equities, but it's quite easy to set up a ComSec account and trade CBA, Westpac shares, et cetera, but to do that in crypto, it's getting easier, but there's still a lot of issues around that. Which exchanges do you use? How do you then store the assets? Do you store them on the exchange? Do you take them off the exchange? Crypto assets are fundamentally bearer assets, so whoever holds them has the control of them. There's no sort of recourse to someone like the ASX to claw your shares back if they fall into the wrong hands. But then there's also other operational things like tax. So every time you trade one crypto asset from one into another, that's a taxable event. And so if you hold 1 or 2, 3 crypto assets, that's not so difficult. But if you do move into that actively managed portfolio, you can imagine that quickly becomes a nightmare, having to account for every different trade which way. So again, the Apollo Capital Fund, it's a multi-strategy fund. It's our flagship fund. It has exposure to Bitcoin, Ethereum, what we call alternative layer ones, so other fundamental blockchains, which I can talk about later. We have a pretty active portfolio in terms of investing in what we call primary deals or new projects. So there's a lot of innovative use cases for crypto assets. DeFi, decentralized finance, was the topic 6 months ago. We've been very active in that space. Sean, I think you mentioned NFTs. We've also got the metaverse, another term which has come out, Facebook changing their name to Meta. And so there's a lot of activity going on, and we try to capture some promising investments. I think one thing with crypto, which most people will be aware of straight away, is it is highly volatile. So we actually, on our newsletter today, which we release weekly, we talked about the benefits of a small allocation to crypto. So we're not out there saying invest 50% of your portfolio in crypto. We're bullish on crypto, but even for me, that's pretty daring. But I think there is a strong argument for a 2% allocation or 5% allocation because when it works, the performance is very strong. It can materially affect a portfolio. When it doesn't work, the drag of a 2% or 5% allocation isn't too severe on the overall portfolio. We do have a couple of other new funds. One is more of an income fund that focuses on some yield strategies within crypto, which I can go into if people are interested in that. But Greg, I understand there's lots of questions coming through. I love the questions. It shows that people are engaged. So very happy to take them today.
Yeah, definitely. And maybe just to start out from overall, when we've spoken, you don't like the word cryptocurrency per se in our last conversation. Can you just go into that a little bit more and just keep it at a high level, if you will?
Absolutely. So, and please remind me on most topics related to crypto. I can talk for a long time on them, but I'll try and get the salient points across.
No problem.
So Bitcoin was the first crypto asset, and in the Bitcoin white paper, which explained how the Bitcoin network would operate, Satoshi Nakamoto, the pseudonymous creator of Bitcoin, described Bitcoin as a form of peer-to-peer electronic cash. And so I think people have started thinking of as Bitcoin in particular as a currency that you can use it to buy and sell things. Again, I could go into great detail, but I actually think Bitcoin's a pretty terrible currency. It's more of a store of gold, store of value, a bit more like digital gold, which you don't use as a currency to buy and sell things. But we prefer the term crypto assets. It's a broader term, and it probably reflects our view that not many crypto assets, currencies, tokens, coins actually are effective currencies. So we prefer the crypto assets term.
Okay. And then, along that line, you mentioned earlier about 17,000 different crypto assets. In a high level, again, can you just explain what the difference is between them?
Yeah, there's a lot. So let's talk about different groups. So we would call the starting blocks as a fundamental blockchain. So a lot of people know the term blockchain, and the blockchain is basically generally a decentralized network of operators around the world. Decentralized, that term is key because no one's in control, and it's generally on a global scale. And people come up with different blockchains that have different functionalities and sort of different trade-offs. So there's a couple of very notable blockchains. Ethereum and Bitcoin are independent standalone blockchains. And then if we look at Ethereum as a smart contracting platform, what that means is that you can build on top of the blockchain. So you can release a crypto asset or a crypto coin or token, and you can build on top of Ethereum that uses that fundamental blockchain. And that might have a different use case. But what it does is it removes the need to create a fundamental blockchain, which is a lot of work, a lot of effort that goes into that. So then in terms of, that's the first consideration is out of those 17,000, is it a fundamental blockchain? Is it being built on top of something? Or it might even be built on top of something else. In terms of how to group them thereafter, we start with what we say is the first killer use case of crypto was Bitcoin as digital gold. That's pretty well understood now, so I won't spend too much time on that. You've then got smart contracting platforms, which are, if you think about Bitcoin as a narrow defined use case, smart contracting platforms are broad. We'll create a blockchain and then anyone can come over the top of it and build things on top of that. So that might be for use cases like decentralized finance. So that's a use case that we think we're very active in. And what that means is I can create a token like Synthetics. synthetics allows the trading of decentralized. It's a little bit like derivatives, but if you think about Tesla shares, there's a synthetic Tesla share, there's synthetic gold, there's synthetic S&P 500. They're synthetics or synths. They're a little bit like derivatives. They take their price from a price feed. And what that does is, well, why is that a big deal? For you and I, it's probably not that big a deal because you and I can go and buy a Tesla share on the NASDAQ. But for 6 billion other people in the world that have a smartphone and an internet connection, they can then go and buy a synthetic Tesla share and get access to a degree of financial freedom that way. So that's one example of a decentralized finance asset. And then there's all these other DeFi assets. The other big group, which people can look into if they like, is this Web 3.0 idea. And so we're less focused on Web 3.0, but it's basically the idea that Web 1.0 was static information on a web page. Web 2.0 was social media, and Web 3.0 is the idea that you can use a web-based project, protocol, platform, and it can have a token that accrues value behind that. And so there's examples like Helium in the States where people can set up internet like beacons in their house, and they can provide internet to other people, and then the internet providers can get these tokens as sort of payment for that. There's other ideas like Filecoin where you can use storage on your computer. So you can have this sort of decentralized network of computers plugged into the network that is kind of like a competitor to Dropbox or your Google Drive and that sort of stuff. So that's another big area that a lot of these tokens will fit into. And then the other, it has to be said, is there's just a lot of rubbish out there. Just a huge amount of rubbish. So what group they fit into, I'm not exactly sure, but that's what we try to avoid.
Right. And Tim, just adding to that, when you said, the first bucket, that's synthetics, are they actually though, like you said, say like you could buy like a CFD on Tesla shares, which is effectively a synthetic. Are they asset backed at the end of the day?
No. They're just a synthetic asset that trade up and down. And if they do what they say they do, they'll copy the performance of whatever they're
right. They'll mirror whatever is the underlying the spot.
That's right.
Okay.
Tim, can you just go into maybe 3 or 4 year history of the returns to date and what you think is the main impact to that?
Yeah, so it's a good question. And one thing that we encourage our investors, probably stronger than encourage, but we make sure they understand is the volatility. I understand your investor base is quite not too afraid of volatility. You can imagine a lot of Australian investors very conservative. But yeah, in terms of best performing months, I think we had 62% in August 2020. I think worst performing months, we had minus 34% in March 2018. So over point to point, we were down 65% at one stage from inception. Unit price was down to like 33 cents. So it's obviously pretty extreme volatility, but now point to point, I think we're up about 5x or 6x for our initial investors. So we definitely think it's a long-term view is needed for this asset class, whether you're doing it yourself or through a fund. And
Tim, in those months, was the actual Bitcoin price up and down similar?
Yeah, that's a good question, Sean. So there is, what we say with the correlations for crypto is that there is a lot of short-term correlation between crypto assets. So yes, in a 62% month, we're not going to see Bitcoin drop. There's going to be a high degree of correlation there. But point to point, the correlation between crypto assets is actually quite low. And a great way to check that is if you go back and see when we started, or 2017, the top 10 crypto assets, I think there's only like 2 or 3 in the top 10 then that are still in the top 10 now. Bitcoin, Ethereum, and maybe Litecoin, or Litecoin maybe not anymore. So that's where I think that active management, picking the winners is important.
Okay. Hey, Tim, also a couple other questions about the fund specifically. There's a lot of questions around trust.
Yes.
How do you hold your assets?
Yes, great question. So we have a multi-tiered strategy for holding assets. The safest, securest is using Coinbase custody. Coinbase, one of the most successful businesses in crypto. For the Apollo Capital Fund, we custody around about 55% of the fund on Coinbase. The downsides of Coinbase are you need to trust Coinbase. Equally, you need to trust us to store it properly on Coinbase. But that's they've got insurance and they've got a very, very strong track record. So I think the risks there are quite low. But also the other downside is they don't support all the assets we want to invest in, nor do they support all the trading activity that we want to trade. So then we also use another solution called Fireblocks. And what that does is that it's a key management software. So if you think you need 3 passwords or 3 keys to move assets around, it stops basically one person in control at Apollo running away with everything. You need 3 people to move assets around. There is definitely a risk that you need to trust Apollo. We've been going for 4 years, so hopefully we've built that track record. And the other thing I'd say is it probably also comes back to the investor's own knowledge and own comfort with securing these things. If they're well trained and they know how to secure crypto assets, then they'll probably do that just as well, if not better than, well, probably not better than Apollo, but they'll do it well. But if you don't know what you're doing, you've read all the media articles, the stories of people losing crypto assets. I've lost crypto assets before personally because I changed the phone. It was only a small amount. Certainly wouldn't do that with a fund. But you hear all these stories of crypto assets being lost. So there are risks for the DIY investor doing that.
Okay. And then another question I'm getting is regulated versus unregulated. And I'm sure we could spend hours on this, but what are your thoughts about regulation?
Regulation, I think, is a risk to crypto assets. In our newsletter again today, we pointed out that Russia was going to ban crypto outright, but now they've changed their tune and they're actually going to regulate it. India did the same. They were going to ban crypto outright and they're going to regulate it. So I think that's a good thing because the likelihood of global regulators coming together and just regulating this out of existence, I think it's got to be pretty close to zero now. And that was only Russia and India, as opposed to the more developed countries like Australia and the US. So I think it's a risk that it might make things a little bit more difficult. The regulators are still getting their heads around around the space. Even a Bitcoin ETF, right? There's ones that have come out that are futures based. They don't have a spot based Bitcoin ETF because of a variety of factors. So I think it's a risk, but I think that risk that it's, as I said, it's going to be regulated out of existence. I think that's looking increasingly unlikely.
Okay. Here. Okay. So taking a turn, but probably we're getting a lot on this. NFTs.
Yes.
Tim, what are your thoughts? And then also maybe after that, we'll talk about Ethereum because it's, highly relevant.
Tim, before you explain your thoughts, do you want to explain exactly what an NFT is?
NFT for dummies.
Yeah. I'll try my best. So an NFT is a non-fungible token. Now, if we go back a step and we think about this concept of digital cash, the reason why Bitcoin was a breakthrough was because for a digital cash system to operate, you needed to be able to not duplicate the asset. If you could duplicate the asset, then your cash is quickly going to become worthless because there's just going to be millions and millions of them. So what the Satoshi Nakamoto did in his white paper was created a blockchain system that allows for what we call digital scarce assets. So you can't just go and create more of these things. They need to be mined, and there's this whole process which governs that. That in itself was a massive breakthrough. And one thing I like to highlight is that had been researched since 1978. It was released in 2009. So there's actually about 30 years and about 4 or 5 serious failed attempts before Bitcoin came along and solved that tremendous puzzle. So now we've got the idea of digital scarce assets. So an NFT, the easiest example is, think of a picture. It's a digital image. And an NFT, what it does is it basically shows provenance. So it shows that if I have the key, I use that term before, it's a key, it's a password, string of characters effectively. If I have that password to unlock an NFT, I can then send the ownership of that NFT to Greg. And now, Greg, you own that NFT. Now, that doesn't stop Sean going out and copying that JPEG many times and sending it to his friends and family and saying, I have this image. You can have a screen in your house and you can put it on your house and you can say, hey, this is my picture. But when it comes to showing provenance, when it comes to showing that you actually own it, it's that key, it's that password, it's the blockchain that works all together to prove that ownership. So how that's morphed is we've got these art-like collectible NFTs that have just exploded in the last 6 to 12 months. Another example might be, and a lot of people have been quite bullish on this for some time, is in-game assets. So think of a game like, you played as a kid, like World of Warcraft or StarCraft or something like that. And you've got these assets which can only be used within that game. A more regular, a more modern day example might be Fortnite. So in Fortnite, you've got these assets, but they can only be used in that asset in this particular instance. But imagine if you could buy a different gun or a bow and arrow or an outfit or something like that. Imagine if you could then transport that to another game. That all of a sudden becomes really powerful, because as we know in gaming, in collectibles, a lot of people kind of want those assets, or they might want those assets. And so you've kind of got this fan base. It's very similar to baseball cards, right? Some people will look at a baseball card and go, that's a piece of paper, it's not worth anything. Some people go, that's a baseball card, and that's amazing, that's a rare collectible. So one thing I do like to point out with NFTs is Ethereum. Vitalik Buterin is a co-founder of Ethereum, and we'll go into that, Greg. But one thing that I always say about crypto is it's just such a fast-paced, evolving space that I think this also makes sense for a fund, is to have someone or a group of people with their finger on the pulse. And the reason that plays into NFTs is that I saw a tweet last year, and the question was, what is the use case that you didn't see coming for Ethereum? And Vitalik, the co-founder, replied one word: NFTs. And so basically the co-founder of Ethereum, which powers a lot of these NFTs, he didn't see it coming. And so my question then is, like, in 6 months, 12 months, 2 years, 3 years, what else is going to happen in crypto that that's going to accrue an enormous amount of value, and then people may or may not see coming?
What?
Okay, cool.
Yeah.
So Tim, we've got a question here from Sharon, who I think is Greg's wife. So it's, hey, handsome, can you stop people from copying your asset? Patent, copyright law, can you sue someone for copying it?
So copying the crypto assets? Yeah, so it comes back to what I was just saying, actually, about like these are digital scarce assets. So you can't just copy them and plug them in, because the way a blockchain works is that the blockchain will reject them unless you have the keys, unless you have the passwords. The question might also mean, like, what's to stop someone attacking us and trying to steal our assets? And that can happen. So I think, Greg, you mentioned before on a call that Binance, which is the world's largest exchange, that got hacked about 2 years ago. They lost $40 million. And they are, Binance, world's largest exchange, doing billions of dollars of trades in crypto assets. They are a target. Everyone in the world knows that they have control of these assets, so they're going to be targeted. Apollo Capital, we're managing 200 million. We may be targeted. We take it very seriously in terms of our cyber protections. But yeah, it's a risk. And then it comes back to, well, Apollo, they know what they're doing. The risks are quite low if you do these things properly.
Got it. And also, with NFTs, and you mentioned it before, Ethereum, how are they tied in together? And also, what is this Ethereum 1.0 versus 2.0?
Sure. So remember at the start, I said that you've got a fundamental blockchain, and then you've got things built on top of these blockchains. So NFTs, a lot of the activity, the trading, the creation, the minting, the selling of NFTs happens on the Ethereum blockchain. And so that's why that's the sort of connection. There are NFTs on other blockchains, but Ethereum is the largest, most well-known, and that's where most of the activity happens. So that answers the question about NFTs and Ethereum. Ethereum 1.0 and Ethereum 2.0. One thing with crypto assets is that you can make changes to the blockchains and how they operate. It's a very tough process, and it's a very time-consuming process, and it happens very, very slowly for reasons you can imagine. There's a lot of value at stake. Ethereum 1.0 is almost like the first initial vision of Ethereum, but one of the problems facing Ethereum is that it's very expensive to transact. So at times, this is actually a personal example, but with a Bitcoin, I was down at my mother-in-law's place, and I was going to send her $10 worth of Bitcoin at one stage in December 2017, and it was going to cost me $30 to send $10 worth of Bitcoin. Now that was because at that particular point in time, it was very congested, and there was a lot of transactions happening. So it's not always like that, but Ethereum has had the similar sort of problems. So Ethereum 2.0 is a whole set of proposals, solutions to move towards a network which has improvements. One of those improvements is bigger throughput, larger throughput, so you can process more transactions. Another is moving to terms people might know as from proof of work, which is the mining consensus algorithm that powers Bitcoin as well, to proof of stake. So it's going to be a more energy efficient way of mining Ethereum and validating these Ethereum transactions. I'm getting a bit detailed there, but again, they're terms that people might know: proof of work, proof of stake. Ethereum 2.0 is going to use proof of stake.
Got it. Okay, another question. What do you think in terms of a bubbles, and does it scare you when people say we're in a crypto bubble or NFT bubbles? Because this history has shown it doesn't always end well.
Yeah, it's a good point. We've been doing this for 4 years now, which in finance is not that long, but in crypto, it's an eternity. And so I've kind of seen a lot of it before. I've seen people say we're in bubbles, and then crypto just continues to rise. I've seen people say that crypto's over, it's dead, and Bitcoin then might go further down or it might rebound. I think let's just keep it simple. Crypto's volatile. There's enormous return potential. If we're in a bubble or not now, or at certain points in the future, we're not going to know about it. My thing I like to get people to think about is you can sort of dip your toe into crypto, and so I think a good way to allocate to the space is to do, if you've got $100 to invest, put in $30 now, $30 in 6 months, $30 in 12 months. Or 1 month, 2 months later, whatever sort of makes sense. Because I've got a mate who I told, mate, you really should buy some Bitcoin at $14,000, and it went up to 60, and he's still waiting for it to drop back to 14. So by getting in and having a little bit in, if it goes up, then great, you're up. If it goes down, then maybe that's a chance to put some more in.
Okay, and then also they're asking, what would you recommend for someone learning and getting educated about, all of crypto? I mean, what's the Wall Street Journal for crypto kind of thing?
I'd head to Apollo Capital website, sign up for a newsletter. I think that's and look, it's a bit tongue in cheek, but I do think we try to. There's just so much noise out there, so it's quite hard. Right. Like I imagine if I was to start now in crypto and go to, start at Google, I mean, you're just going to be bombarded with all sorts of information. So we're obviously biased. We obviously, think that it makes sense to invest in crypto, but we do. The way I often explain it is, you've got people out there thinking that crypto is used purely for money laundering and purely for evil. You've got people out there thinking crypto is going to save world hunger. Like it gets a bit silly at times. So we try to take a sort of a middle, not quite middle, but maybe more towards, it's a good thing approach. So that I think and then if you head to our resources page, we've got beginner, intermediate, advanced. We've got a bunch more material there that if you want to get in touch with trusted sources, we're very happy to help people.
Got it.
All right. Well, Tim, we will be putting the investment on the platform tomorrow, which is great. And someone is just asking what that minimum investment will be. I think it's going to be between 25 and 50,000.
Yeah.
Is that
That's right. So technically the minimum's for 50K for people coming in publicly to the Apollo Capital Fund, but as a favor to 180 Markets, we're happy to drop that to 25. And again, it comes back to what I said before. People want to dip their toe in. They want to get comfortable with us. They want to get comfortable with your asset class. So that makes sense. Yeah,
and generally you don't put your last dollar in first to these types of things anyway. So that's
exactly. That'll be available tomorrow. Before we finish off, does anyone want to unmute themselves and ask Tim a question?
I did get one question just on WhatsApp, Tim. They're asking about tax implications. Does the fund give investors like a tax form at the end of the year?
Yeah, that's exactly right. So one of the things we tried to do at Apollo is crypto's complex. Let's try and keep everything simple. So our terms are simple. We've got monthly applications, monthly redemptions. The fund is an Australian unit trust, and so it operates very, very similar to any other Australian unit trust. So there will be a distribution throughout the financial year if there's net positive realized trading gains and income, usual sort of stuff. And yes, statements are provided to investors.
Right. Okay. If anyone wants to unmute themselves, feel free to. If you want to just, WhatsApp or, email us questions, and I'm sure we can follow up with Tim. Okay, everybody. Tim, thank you so much again. We very much look forward to it, especially for us novices. Again, it's something that our investors have been really, Sean, I don't think that more than, a few days go by without the question.
Oh, no, it's at least once a week. It's, what do you think of crypto? Have you invested?
Right.
Should we start?
And how do we get set?
Yep. So great chance here. And Yeah, thanks a lot, Tim. Appreciate it.
No worries, guys. Thanks for having me. And yeah, no, enjoyed the chat. If anyone does have any more questions, I'd be very happy to answer them.
Thanks. Bye, Tim.
Okay, thank you.
Thank you for watching another presentation by 180 Markets. Don't forget, if you want access to thousands of ASX capital raises, head on over to 180markets.com.au, sign up, and get on board for our very next capital raise. Thanks for watching.